Welcome back to the Short Put Masterclass. My name is Stephen Cox. I'm a full-time options and futures trader, and I'm the CEO of Share Navigator. In episode 1 of this masterclass, we highlighted that the short put strategy is a high probability strategy. Now we're going to focus on one of the most popular ETFs, SPY, which tracks the S&P 500. And we're going to show you why you get a statistical advantage with this strategy with SPY. But before we go on, I think it's important for you to understand that you can use the short put strategy as a return-based strategy only, or a stock allocation strategy, or a mixture of both. So a return-based strategy is when you have absolutely no intention of taking assignment of the shares. So remember, when you sell a put option, you're selling an insurance policy. And there's a risk there that you might have to go and buy the shares if they fall below a certain level. If you don't want to take assignment of those shares, you use a return-based strategy, and you will use some trade management features, which we'll discuss in episode 6, to avoid getting assignment of the shares. The stock allocation strategy is when you're selling put options in order to get assigned a stock. Think of it as simply as this. You're just looking to get paid now for agreeing to buy shares at a date in the future, which you were going to buy anyway. And the good news is that SPY fits both of these strategies, and we're going to explain why over the next number of slides. So why do we like SPY so much for the short put strategy? Well, first of all, SPY is an exchange traded fund that tracks the S&P 500. That gives you instant diversification, which means less volatility. Because your risk is spread across over 500 companies that make up the S&P 500 index. Secondly, if you were assigned SPY, even if you did apply the return-based strategy, but you got assigned on SPY, SPY is built to go up over time. Yes, there will be downtimes. You will have COVID events. You'll have the financial crisis. But just think about how the S&P 500 index is built. It's built by the best performing 500 companies in the New York Stock Exchange and the NASDAQ over a period of time. And the underperforming companies are replaced by the overperforming companies. So it's actually built to go up over a period of time. But just to highlight again, that doesn't mean it's not going to go down. You're not going to have your bad years. Of course you are. But if you stay long enough in the S&P 500 over time, you should make a profit. But here's the most important part for this strategy, the statistics. Statistics show that 90% of the time, the S&P 500 will operate on a monthly basis by plus or minus 5%. We can use this knowledge to our advantage, and we're going to show you how over the coming slides. And remember, you get peace of mind if you do get assigned SPY. You're not going to lose any sleep about owning SPY. The key to turning this into a high probability strategy is selling out of the money short puts. So what's an out of the money put? It's when the strike price is below the current share price. And the further out of the money you go, the higher the probability of profit. So here are your trade-offs. The higher the probability you want, the lower the premium you're going to take in. And then the lower the probability you want, the higher the premium you take in. And everybody is different. You've got to decide which suits you. So remember back to our previous slide, we talked about the stats on SPY, and that 90% of the time SPY operates within plus or minus 5%. Well, if you sold a put option, which is at least 5% out of the money, you should have circa 90% probability of being profitable at expiry. And the great news is when you're placing these trades with your online broker, you're going to get that probability of profit. But if you're looking at an option quote screen, and we're going to share more with you in another episode on this, just choose a delta below minus 0.2. Here's a typical option quote screen for SPY. So you can see at the time of doing this video, SPY was trading at 684.14. And on the left-hand side, you have call options. On the right-hand side, you have put options. And in the middle, you have the strike prices. So you can see, first of all, for the 643 strike, for example, you're taking in about 501 per share. But if we went to the 640 strike, you're taking in 468, which is lower. So the further out of the money we go, the lower the premium we take in, but the higher the probability we have of being profitable. And again, everybody will decide this for themselves. What are your rules for trading and investing? So when selling put option, which expiry should you pick? Well, we prefer 30 to 60 days. And this is known as kind of the sweet spot due to a Greek called theta, which we'll discuss in another episode. Also in this time frame, if the trade starts to move against you, it actually gives some time for it to recover too. So in short, we prefer time expiries when selling put options of about 30 to 60 days. So back to our SPY put option quote, you can see on the right hand side we're focusing on inputs, and we've selected the December 19th, which is 49 days to expiry, as the expiry date we're going to use. And we're going to focus in on this 640 put option, and we can see that we're due to take in $4.68. So we're going to use this example now for the rest of this masterclass. So we've set the scene with our example. The current share price of SPY is $684.14 at the time of doing this video. We have sold a $640 put option, which expires in 49 days, and we took in a premium of $4.68 per share, or $468 per contract. Our break-even price was $635.32. So that's simply the strike price minus the premium we took in. And the difference from where the share price is currently trading now to our break-even price is $48.82 lower, which is 7.1% lower. In other words, SPY could fall 7.1% in the next 49 days and we would still make a profit. That's why this is a high probability trade. The share price of SPY can go up, it can go sideways, and it can even fall by 7.1% and we still make a profit. The probability of profit in this trade is over 80%, but we're going to show you later on when we show you the mechanics of placing the trade, where you're going to get that information from. So combining the long-term bullish bias and diversification of SPY with disciplined selection of out-of-the-money strikes is the foundation of our high probability short put strategy. Next, we're going to dive into two of the option Greeks, delta and theta. And these are the powerful mathematical tools that measure the risk and rewards of this position.